Are you sure?
Here's the 30-second lesson on what legends know. Never ask a bride why she's getting married. Don't wear a skirt on a windy day. Deodorant is not a shower. Don't sniff chili flakes. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor, and this time we're going to be talking to you about what the RBI has found about the financial stability in our overall system. They've looked at banks, NBFCs, even a little bit about the stock market. But overall, they're trying to see whether these systems are still stable, robust, and strong. To analyze all of this, of course, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, let's first start with the good news before we go into what the concerns the RBI has raised. So the good news has to do with the NPA level. So could you tell us a little bit about those?
Sure. So NPAs have been showing a declining trend since 2019, and they have now fallen to a multi-year low of 2.8%. That is for scheduled commercial banks as a whole. As per September, the NPAs were 3.2% of the total advances. Now they have fallen to 2.8%. So that's a good news. Also, if we look at net non-performing advances, net non-performing assets ratio, which is after excluding the provisions, there also we see the NNPA ratio has come down. It has come down to 0.6%. So overall, there is a decline in the NPAs, or in other words, an improvement in asset quality. Also, sectorally, there has been a reduction. So if we look at agriculture, industry, services, retail loans, everywhere as compared to September 2023, if we look at the second half of FY24, we see a decline in the NPAs of agriculture, industry, services, retail. The lowest NPAs continue to be in the retail segment, though there were concerns raised. But as of now, the stock of NPAs is the lowest for the retail segment, and it is still highest for agriculture, though there has been a decline, but still above 6% is the GNPA ratio for loans in the agricultural segment. So that is the overall picture. Also, what is more, a significant point to note is that there has been a faster decline in the pace of NPAs for public sector banks. So there is around 75 basis points reduction in the GNPA ratio of public sector banks from the first half of FY24 to the second half. So that is another, noteworthy point when we talk about the asset quality of the banking sector as a whole, because we remember there was a time in 2018 when public sector banks NPAs used to be very high, above 10%.
Absolutely.
And there used to be a big gap between the NPA ratio of public sector and private sector banks. And now that gap is narrowing because of the faster pace of decline in the GNPA ratio of public sector banks. So overall, if we see public sector banks, GNPA ratio is 3.7%, and for private sector banks, it is 1.8%, and overall, it is 2.8%.
Right, and I mean, of course, there's historically in India, we kind of feel that the public sector banks, because they're connected to the government, that there's less scrutiny about, the loans that they're giving out, and so that means a lot of them become NPAs, and that they're less efficient than private banks. But these numbers show that it's not the case. They've improved their credit quality quite a lot.
Yes, and if we look at the drivers, what has driven this reduction, there are two drivers. One is, the slippages. Slippages are the addition to NPAs in that particular period. And we say that these slippages have also declined, but at the same time, it's not that write-offs are not taking place. Write-offs are still taking place, though in absolute levels of the magnitude, there is a decline, but in proportion to NPAs, they are still stable. So the slide in NPAs that we are seeing is driven by both reduction in the slippages, that is, the net addition to GNPA is slowing down, and therefore we are seeing a decline in the stock of GNPA ratio. But the other thing is that the write-offs are also there. So both have contributed to a reduction in the GNPA ratio.
And write-offs would be okay if recoveries of the written-off loans was also happening at a
Yeah.
brisk pace. But I think the latest data we have in one of the parliament answers was that it's only about 10% of written-off loans have been recovered.
Yes, but it is still a positive response because it frees up your resources
Absolutely.
for lending. You know,
Yes.
you have the banks have provisioned an amount for these bad loans and they have turned toxic. So at one level of effort is to do the recovery, but at the other front, it's also necessary to unlock the capital for other fresh sources of lending.
Without a doubt. Otherwise, you just have banks that are not lending and you have companies that are not borrowing. And
Absolutely.
that's a bad situation. So now let's get to some of the concerning areas. So from your article, what I could tell is that the NPAs in the personal loans category are not alarming right now, but they're moving towards some sort of worrying areas.
Yes, so within the personal loan segment, though overall we see that it's still lowest as compared to the various sectors.
Right.
But what is a point of concern is that the NPAs in the education loan segment is quite significant. It's around 3.7%. And if we look for public sector banks, the NPAs of in the education loan segment is 3.9. Now, it is a problem because overall the share of education loans in the overall retail portfolio is just 2%
Right.
overall, and for public sector banks it is 4%. But still, the NPA proportion is higher as compared to what we would have thought for some of the consumption segments like credit card outstanding or for auto loans. But we are seeing here that though there is a general decline, but still, if we look at the various sectors, amongst the various segments of retail loans, it is the education loans which where the NPA levels are still significant, and that has something to do with the state of job market or the state of employment, because students are borrowing and public sector banks are willing to lend till 4 lakh of loan. It is without any collateral, and then the collateral requirement kicks in. Post COVID, there has been a resurgence in demand for education loan, but given the state of job market, it is indicative of the fact that they are not able to pay back because either they are not getting adequate employment opportunities,
or the income level is low,
or they are being laid off. There are so many, there's freeze on hiring in so many companies.
Right.
So I think it's an indication of that state of affair which is getting spilled over to education loans. Now, whether it's is a cause of systemic concern as of now, no, it is not.
Because education loans are a
Very small proportion, but at the same time, it is something that needs to be watched out for, particularly for public sector banks. It's because it's not the private sector banks that are doing more of education loans, it's the public sector banks that are doing. And given that, again, like agricultural loans, the recovery is politically sensitive.
Yes.
Therefore, there has to be some mechanism to check the spurt in NPAs going forward, or to have some mechanism to keep an eye for. So this is something that needs to be watched out for.
No, right. And the thing with education loans also is that, I mean, anybody could tell you, I'm sure even you would know, school fees, college fees, all of these are just rising year after year after year.
So,
and if incomes are not rising, people are going to take more loans. So even though education loans are a small proportion now, that proportion is likely to rise.
And given that many students are opting out for higher studies abroad, the demand for education loans is rising. And if we see the pattern, the trend of education loans, monthly year-on-year growth is around 23 to 24% every month.
That's quite strong.
So that means that after COVID, there has been a resurgence, primarily as you are saying, due to escalation of course fee and due to the point that students are opting for higher studies elsewhere abroad. So that has resulted in a boom in education loan, but it's not getting translated into repayments, into timely recoveries because of the tepid state of the job market, and that is getting reflected in higher NPAs.
Right. And so now in the retail loan category, which is what affects all of us, Are there any other signs of concern?
As of now, there are no signs of concern. But what is important is to look at the slippages. And here, when we see the fresh additions to this NPAs during this second half, we see that for private sector banks, the slippages have been contributed 40% by retail loans. So something to watch out for, that as of now they are not NPAs, but the slippages are rising in the private sector banks. The slippages are rising 40% due to retail loans. So
perhaps we should also explain just briefly what a slippage is.
Yeah, so slippage is the net addition to the stock of NPAs.
Right.
So the fresh additions of NPAs during that period. It may well be the case that all of the slippages do not translate into NPAs because they may be repaid. But
Meaning
as
that
of now,
it's delayed, but then they repay.
they repay. But as of now, as of the period for which the report has been written, which is up to March 2024, from September 2023, there are fresh additions to the stock of NPAs, and that is mainly being accounted for by retail loans in the private sector banks category. So this is again something to watch out for. It may well be that not all of them are translated into NPAs at the end of the relevant period, but it is something to see that again which segment is contributing to the rise in slippages and what could be done to address that.
Right. And now, apart from banks, the report also looked at NBFCs,
Correct.
Non-banking financial institutions or companies. And they are a very large part of our lending system because they lend to all of those people who the banks will not lend to.
Yes.
So looking at their health is also important. So what does the RBI find?
So there also we see that there is a general reduction in NPAs. Again, good news. Asset quality has improved. So NPA ratio has fallen to 4% from 4.6% in September 2023. Again, another noteworthy point is that the pace of retail loans has slowed, which is something which RBI expected. Yes, RBI has been trying to do, and that is getting reflected in at least the retail loan portfolio of NBFCs, because if we remember in November, RBI increased risk weights for both banks lending to NBFCs and NBFCs lending to retail component unsecured personal loans. So at least for the retail loan segment by NBFCs, we are seeing a moderation, at least in the second half, which is again something which is good news. Their capital position is also quite comfortable, just like banks, their capital position is comfortable. But again, the cause of concern is that overall, if we look at the entire spectrum of financial system, they are the net biggest borrowers. Okay, so they are the biggest borrowers, and their borrowing is primarily coming from banks.
Right.
Though it is long-term borrowing, so which is again something comforting that it's not short-term borrowing. The asset liability profile is not disturbing as of now. It's not that they are borrowing short-term and lending long-term and vice versa. That's not the case. But in terms of the fact that they are the biggest net borrowers in the entire financial system. And then the second biggest borrower is the housing finance companies. So we look at, the financial stability report looks at the net payables and the net receivables, what they have to pay and what they will receive. There's a big gap between what they are supposed to pay and what they are supposed to receive, and that is mainly coming from banks. So again, there is this interconnectedness between banks and NBFCs.
Yes.
So if there is a solvency problem with NBFCs,
which we have seen in the past, so that could spill over to banks, because earlier that solvency situation had spilled over to mutual funds, because mutual funds had invested in the bonds of those NBFCs, the troubled NBFCs, the episode that we saw in 2018, the IL&FS crisis, the SREI crisis. So there was a nexus between NBFCs and mutual funds. Mutual funds were lending to NBFCs. Yes.
They were subscribing to the corporate bonds issued by NBFCs. And since then, the mutual funds have slightly distanced themselves from NBFCs, and banks have become the largest source of lenders. So there is this risk of spillover of the spillover risk from NBFCs to banks, which need to be avoided. So that's the second area of concern which the report has highlighted.
Right. And now the third area in the financial system that the report briefly mentions, because this is not directly under the RBI, but it's the stock market. And here I have a question from the audience, which neatly asks even my question, which is that is the fact that the Sensex is doubling in 5 years with 8% growth in just the last 2 out of these 5 years going to harm our financial stability? We just crossed the 80,000 mark, the
80,000 mark,
Sensex,
yeah.
and it's the fastest from 70,000 to 80,000. That 10,000 jump was the fastest in the history of our Sensex. Does this affect our financial stability at all?
So by itself, if we look this metric in isolation, we cannot judge that it is something that will harm financial stability. There are various metrics to look out for. One metric is the VIX, the stock market volatility
right.
indicator, which is telling us about the expectation of investors about volatility. So what do they expect about share prices? What is their perception about the health of the stock market? So VIX is a very important indicator to watch out for. And during elections, we saw that this VIX indicator skyrocketed,
up, yeah.
and now it has come down. So that is something to watch out for. Of course, there will be these short-term spikes in VIX due to multiple factors. But if there is a sustained, increase in VIX, that is something to watch out for. That is something that could have implications for the stability of the financial system. And then we need to understand what are the drivers, what is driving this VIX above its threshold value, or the safe range. The safe range is expected to be somewhere between 13 to 19, that index value. And if it continues to rise above that level on a sustained basis, then we can say that there could be some implications for financial stability. Because when we talk about financial stability, there are a lot of indices. There's entire area of literature which tracks what is called the financial stress indicators, which is a composite of what's happening in the stock market, what's happening in the bond market, what's happening in the banking sector, what's happening in the money market, what's happening in the NBFC space. So stock market is one element of the entire financial system, and therefore we need to watch out for undue fluctuations or volatility in the stock market. Currently it has scaled above 80,000 due to a confluence of factors, one of them being that they are now expecting the Fed to cut rates.
Yes.
So that is one important thing, and banking stocks are driving the stock market because there is expectation that HDFC would be included in MSCI EM index.
Yes.
So there are these short-term episodes of rise and fall, but overall one needs to see where the VIX is going and see that in conjunction with the macro developments, and that will give us indications about whether it is something unhealthy for financial stability.
Right. And actually, I have been speaking to a lot of market analysts about this, and what they're saying exactly about this macro stability part is that the economy right now is doing quite well. And so it is expected that the stock market will rise. Don't take this as advice from me. We don't give any stock market recommendations, but it is not unusual for the stock market to rise when the economy is doing well. It's not an alarming sign. So now Mridul has a question. He says that the dependence of industry on bank loans is still quite high in India due to the lack of our corporate bond market.
Absolutely.
So what is the current status of the corporate bond market, and how can we make it more robust?
Yeah, so this is something that needs to be developed within the realm of financial markets, because ideally what should happen is that the big industries or the big firms should rely more on corporate bond or market-based financing, and it is the MSMEs or the small firms which have relationship with banks. They should rely more on banks. So that's the ideal situation, and that we see is the situation in advanced economies or in other countries where we see a proper well-developed financial system. But that is not the case here. Here we see that, as rightly pointed out, the reliance of industries on banks is higher. So we need to look at some of the statistics of what is ailing the corporate bond market. One of the point is that corporate bond market is dependent on government bond market. So So if the government bond market will be developed, if we have a proper yield curve, which is that at every maturity we have an yield.
Yeah.
Which requires that we have bonds of various maturities, and various bonds are being traded in the secondary market, so that we have a benchmark yield for every bond. So that will serve as a benchmark yield for corporate bonds. Yeah. So it's very important. The first precondition is that the government bond market should be well developed, primary market as well as secondary market, and there should be a well developed yield curve. The other problem, if we look at corporate bond market in particular, is that it's mainly being relied upon by financial firms.
Yes.
Yeah, and they are those firms that are AAA rated or AA rated. So manufacturing firms do not, it's a rarity that they go to infrastructure firms. They are not relying on corporate bond market. What is needed is we need a diversified pool of issuers as well as investors. Right now that is not the case. We have some investors that are long term. We have insurance firms, we have pension funds, and they would like to invest in long term bonds. But on the issuer side, they are those entities that who would like to issue short term bond. So because of this misalignment, we don't see a very active secondary market. India's corporate secondary market is not that developed. Even if we look in terms of the size of corporate bond market, it is quite low as compared to the overall advanced economies. It's around 18 to 20% of GDP. That's the size.
Right.
So there are these. Another problem is that most of the issuances are privately placed. We don't have the kind of a stock market platform corresponding in the bond market. Most of it is primarily, while the share is reducing, but if we look at, the share is mostly of privately placed, AAA rated financial firms. So what is needed is a diversified pool of issuers as well as investors with varying risk maturities, with various appetites, and that would give some impetus to corporate bond market as well as development of government bond market. Other things are like, repos in corporate bond market. Some steps have been taken, but they need to be taken forward, and ultimately the government bond market is a precursor towards the development of corporate bond market.
Okay, and now about another aspect of financial stability, something that we have actually talked about. Abhinav asks that despite raising the risk weights and repeated commentaries by the RBI, retail lending, especially in the non-housing, non-education sector, is rising very fast for personal consumption and for credit card loans. So when we see this together with other data like the fact that net financial savings, that rate is at decadal lows, and that private final consumption expenditure growth is also not that robust, do you worry if this may be some sort of crisis in the making? He asks.
So that is true that after imposition of weights also, we don't see a very significant moderation in the retail loan space. There is some moderation, but it's not a sustained moderation. Right. In fact, in May, if we look at the recent data, there has been again a pickup. So that is something to worry about. That is point number one. Secondly, net financial savings, we've talked about earlier that there has been a compositional shift towards physical savings due to a number of factors, due to low interest rates and the fact that there is an increase in demand for real estate, gold. A number of factors have contributed, but there are these indications that in FY24, because the recent data that we have from RBI is for 2022-23.
Right.
Now for the next year, it is expected that there would be some improvement in the net financial savings, which had fallen to 5.3% of GDP. It is expected to increase. If we look at the various leading indicators, like if we look at the asset under management of mutual funds, they have increased by 33 to 35%. So there are some indications that net financial savings would improve in FY24. Now, having said that, if financial savings do not pick up, it would become a problematic area at a point when private investment starts to pick up. Right now, we are seeing even that is anemic, but when the private investment picks up and it needs funds, it would be very crucial for household financial savings to provide the adequate pool of investments needed to intermediate that into private investment. So right now it may not be a cause of concern, but going forward net financial savings need to pick up, and if we see sustained decline, then definitely it would have implications for private investment and also for financial stability.
Okay, and now I know we're in the run up to the budget, so questions like this that I'm going to ask you are inevitable. It's not directly related to our topic, but I still will ask because several people have asked this question, which is that does the government have the fiscal space to implement some tax breaks that are needed to stimulate private final consumption expenditure? Various people have asked this in various ways. People have asked, can income tax be reduced to zero? All kinds of things. But in the run up to the budget, that's expected. So.
Yeah, it is expected, and given that consumption demand is muted, there is a valid expectation that tax rates should be tweaked, and there are considerations are going on either in the form of reducing the tax rates or simplifying the tax slab or increasing the standard deduction. Considerations are definitely going on, but whether that will happen or not, that needs to be seen, because definitely there is fiscal space, but there are various demands on the finances. There are various demands from finance minister. There are demands to step up capex, particularly in the rural sector, to provide jobs in the rural sector. There are also demands to increase the transfers to farmers. So it needs to be seen how the balancing act will happen. If the government chooses to reduce the the thrust towards capex, then maybe there could be fiscal space towards reducing tax rates. So on the other hand, given a coalition government, there would be some impetus towards job creation, towards social sector, health, education, skilling, which is again equally important. So there are these conflicting demands. Definitely fiscal space is there, also enabled by the hefty RBI's dividend transfer. But what ultimately government focuses on, that needs to be seen when the budget is announced.
Of course. So there you go. Basically our financial system is robust, it's strong, there's no sign of any sort of alarm, but there are little areas of concern. One is to do with education loans and how a lot of them, especially for private sector banks, are becoming NPAs, starting to become NPAs. Now we know that education loans are going to grow in the future because education is getting more and more expensive. So this is something to watch out for. The interconnectedness of NBFCs and banks, that's another thing that is raising a little bit of concern, because NBFCs by their nature are a little less stable than banks are, because they're catering to a population that is not as financially savvy, that's not as financially strong, and so they will be less stable. But the interconnectedness with banks, that is causing some concern. Now the declining financial savings of households, that's another area that needs to be watched out for. Things might improve, but if they don't and private sector investment starts growing, then that could again cause a little bit of friction in the economy. That could be a problem. That's another thing to watch out for. So there's nothing really alarming right now, but these are all things that we need to watch out for. But on that note, that's all from us. Thank you so much for watching.